Hi, I'm Cesar Alvarez, and welcome to Ask Me Anything. Today we have three questions we'll be answering. The first one is, have you used HV10 over the HV100 ratio? Have you found any value in it? First of all, HV stands for historical volatility. It's just a measure of how much the closing price of the stock or ETF, whatever instrument you're measuring, is jumping up and down. The ratio is often used in a sense of mean reverting. I've tried testing this ratio quite a bit. I have never used it in one of any of my personal strategies. I know back in the mid-2000s, Larry Connors used to use this ratio. And maybe the ratio doesn't work anymore, or maybe I haven't found the right combination. But for my own trading, I have not found the ratio to be helpful. So like I said, I haven't found it to be helpful. You may find it helpful. It's often used, you are looking for low ratio or high ratio to come back. What I have found helpful with historical volatility is in ranking for if I've got a stock strategy. You rank by the highest historical volatility or by the lowest historical volatility. Those two ranking methods, whether the 10, 8, or 100-day or 21-day, that works quite often. I definitely use that in my trading. Another great use of historical volatility is to use it as a filter. So, say I'm not going to trade stocks with higher, historical volatility higher than 50, or I only want really volatile stocks and I want them greater than 60 or something like that. So that is how I tend to use historical volatility, not as the ratio. Now on to the next question. When trading multiple strategies, how do you decide what percentage to allocate to each? This is a great question because I think everybody should trade multiple strategies. And I'm trading 4 right now. The way I typically do this is I'll take each of the strategies, I'll take the equity curve, and then I'll run a portfolio of portfolios in that sense and determine what kind of allocation. Normally I start about equal allocation, so about 25% each. I then look at how correlated are the strategies to each other in the sense of when do they have their drawdowns. I don't want strategies to have the same drawdown at the same time, preferably. Unfortunately, sometimes correlations all go to 1 when things go to hell. I'll look at that. I'll look when they have their draw lengths. I'll look at yearly returns and say, okay, who has good years, who has bad years. Hopefully they kind of complement each other. That's the main thing, putting my strategies together. For the weighting, I start equal weight and then I start adjusting. I just added a very volatile method strategy to my list, and that one's only getting 10% because it's so volatile. For a while, I had 2 mean reversion strategies, and let's go pretend I was trading them both at the same time. I did not allocate 25% to each, but I combined them and said, okay, both of these, I think I had 35% combined was what I was allocating to them because they were so highly correlated most of the time. But they were 2 strategies that at times weren't correlated. So I really liked them at the time. So that's why I was doing that. So it's a little bit of trial and error in the sense of getting a feel for what you're trying to do. The main thing is when you've got multiple strategies, you want them to complement themselves. You don't want to be trading 4 mean reversion strategies that all go up and down at the same time. You can trade 4 mean reversion strategies, but you have to really tweak them quite a bit, or even trend following strategies such that they're not all making money at the same time. The idea of multiple strategies is when one's working, some of the other ones may not be working, and vice versa. They help complement each other. The next question is, what do you think about asset allocation ETF strategies like Ray Dalio's all-season portfolio? I love these kind of strategies. I traded these kind of strategies for a while until I did a little bit what they're going to ask a secondary question, which I'll get to in a second. So these are strategies, if you're not aware of them. They trade a small basket of ETFs, and usually it's something like the U.S. market, like the spiders, a foreign market, an emerging market. They could have commodities or gold or bonds in their mix, and they're usually once a year rebalance your portfolio. Now, one of the things I don't like, especially about Ray Dalio's, is I'm not a gold trader. I don't believe in gold in the sense of just trading it as an asset. And Ray Dalio has gold in his portfolio, so if something like that, I would not trade. But yeah, I would substitute something like DBC, the commodities ETF. There's a whole bunch of others out there. There's the Global Equities Momentum by Gary Antonacci. There's a 3-way model by Ned Davis, the Permanent Portfolio by Harry Brown, the Ivy Portfolio by Medibane Faber. So there's just lots out there to choose from. I think they're all good strategies. His follow-up question to that was, what do I think about potentially the edge going away in these strategies because they're such long-term hold? I don't think the edge will go away, mostly because they're long-term holds. And unless everybody's doing it on the first of the year, you know, you're not going to lose that much of your edge there. The problem that most people don't understand about these is they can go through periods of very long underperformance if you compare them to, this, say, the SPDR or like a 60-40 SPDR bonds portfolio. Just because, I mean, like take our recent performance in the S&P 500, it's just been on fire the last few years. So portfolios like this are really hard to compete against that because you have just one sector that's just going crazy and all the other ones have to do, depending on how they're doing, what its makeup. So that's one of the harder parts about this is dealing with the long, I wouldn't say underperformance, but compared to, let's say, the SPDRs or S60-40, that's one of the harder parts about trading these. And then the last part about this is, what about adding some sort of market timing to these? And I think that's a great idea. That's what I've now done in some senses, is done. The next level is add my own market timing, tell me when to get in and out of these. And I think that is a good thing. The problem with that is it typically reduces your returns, but it also really tends to really help with your drawdowns. Well, that is it for today. If you have any questions, email me or put them in the comments below, and we'll get to them next time.